It is a pleasure to be the keynote speaker at day 3 of Financial Inclusion Week. I'm Edoardo Totolo. I'm Vice President of Research and Programs at the Center for Financial Inclusion. Today, I'd like to talk to you about embedded finance, which is a term that has gained a lot of popularity in recent years and has been flagged, especially in investment communities, as the next big disruption in the financial services sector. There's not a commonly agreed definition, but embedded finance is normally referred to as an application of fintech that entails the integration of financial services within the business model and operations of non-financial firms. In basic terms, this means that, for example, you have a tech platform, such as an e-logistics or e-commerce platform, providing financial services to the users, even though they are not a financial service provider themselves. It is very difficult. It is very difficult. Sorry, I'm hearing an echo. It is very difficult to have accurate statistics on the size of the market, but according to some estimates, embedded finance accounted for nearly 5% of the US financial transactions in 2021. And by 2026, the transaction volumes are expected to triple. Volumes are also growing and investments are growing in emerging markets and developing economies as well. There is a lot that can be said about embedded finance. And if you followed Financial Inclusion Week over the past few days, you probably noticed that there are many people who are really excited about the role that it can play in financial inclusion. But in this keynote, I would like to focus your attention not just on the potential of embedded finance, but also on the need for regulators to better understand the business model and better understand the risks that are emerging for consumers. And I'd like to leave you with 3 main messages. The first is that embedded finance is actually an old business model. However, in the digital economy, it has the potential to revolutionize how small businesses access and use financial services. Why is it old? Well, if you think about it, financial services have been embedded to the real economy for a long time. Think about buying a car from a car dealer. Many dealers in the US and in other parts of the world provide loans to help consumers buy a car, whether the loan is provided directly by the car dealer or whether the dealer had to set up a separate financing company or is partnering with a bank. These are all different operating models, which are all very important to understand and we'll talk about later on. But at the very essence, they entail that consumers obtain a financial service at point of sale. They do not have to metaphorically walk across the street and visit a bank branch to get a loan and then walk back and buy the car. They actually can get everything on the spot. But then you may ask, if this is an old business model, what is exciting about it? Why is everybody talking about it, including at Financial Inclusion Week? Well, the car dealer example comes from a real economy, the brick and mortar economy, and this has clear limitations to scale. However, embedding finance to products and services provided in the digital economy is taking embedded finance to a whole new level. The speed, volumes, the data availability, and capacity to make financial services not a standalone product, but a function embedded horizontally across all sectors of the digital economy has the potential to revolutionize the market. Providers can provide their capacity, can improve their capacity to manage risk and tailor the services around the needs of the users. But there is more to it. If the sale of financial services is not done in isolation, but rather it is done jointly to the sale of an actual service or product, then the cost structure and the incentive structure may completely change. We've seen cases where technology platforms consider the cost of finance as an operational expense that boosts their overall revenue. Financial services in this case are not treated as a separate revenue stream on which they are reliant, but rather it is an operational function that enables growth of their core business. For example, when an e-commerce platform provides working capital to their merchants, this means more product listings, more traffic, more transactions, and more commission fees. The platform can cross-subsidize the financing component to the users if the availability of credit boosts its other income, which comes from the sale of actual products that they're selling. In the long term, this dynamic may change how providers price financial services, and potentially, financial services may become not only more accessible, but also more affordable in the long run. However, at this stage, we need a note of caution because we have to be careful about excessively optimistic predictions at these very early stages of the market. Providers will not reduce margins unless they have to, unless there is credible competition in the market. But in the digital economy, we see increased pressure towards concentration. And in embedded finance, consumers rarely have the option at point of sale to choose between different providers, and users are often not incentivized to shop around for more affordable products because the search costs are high. We have seen in the past many innovations in finance which held a great promise to accelerate financial inclusion and ended up harming consumers, causing defaults, decline in financial health, and over-indebtedness. And this leads me to the second message that I want to leave with you. Embedded finance is actually an umbrella term that combines a wide variety of operating models, business models, and legal structures, many of which fall outside the purview of regulators. The very loose definitions and contours of what embedded finance actually is makes it difficult for regulators to differentiate between what should be enabled and promoted as a means to accelerate financial inclusion and what instead represents a risk for market integrity and consumer protection. To simplify the enormous complexity that we see in the market, I like to divide operating structures in two broad categories. You have in-house embedded finance, and then you have partnership-based embedded finance. And then each of them can really be further subdivided in multiple categories, but bear with me for a second. In-house embedded finance essentially means that technology companies themselves provide financial services, either on balance sheet or off balance sheet, for example, by setting up special purpose vehicles that are financed in the capital markets, or by setting up captive financial institutions. Partnership-based embedded finance, on the other hand, involves the collaboration between a technology platform and one or more financial institutions, which could be banks, payment operators, fintechs, among others. In all these different models, the common denominator is that we see unregulated non-financial firms playing an increasingly important role in the design and delivery of financial services. Kristalina Georgieva, the managing director of the IMF, last week at the annual meeting said that since the financial crisis, they let the non-bank financial sector meander in the wilderness. And these are her words, I'm not paraphrasing. And that the sector, the non-bank sector, has gobbled up too much risk and has become too big. She was very direct. And the reality in embedded finance is that this goes one step further. It is not just the non-bank financial institutions that play a prominent role. It is the non-financial institution. It is the technology platforms that do not have finance as their core business who are playing an increasingly important role. In some business models, their role may be limited. For example, a tech platform may simply make a referral to a bank, and that is quite uncontroversial. On the other hand of the spectrum, some non-financial firms are actually providing loans and other financial services. And in between these two extremes, there are all kinds of configurations. Tech platforms may or may not play a role in interfacing with consumers. They may develop credit scoring models using their own data or outside data. They may channel repayments. They may be involved in the marketing of the products, etc. The challenge here is that it is becoming increasingly difficult for consumers to really know who's providing the financial services that they are using and who should they interact with when there are problems, for example, when there is a dispute or a complaint. From a regulatory point of view, the risk is that there is an increasing volume of financial activity happening partially or completely outside the reach of regulators. Who is responsible to ensure that consumers are given accurate information, that there are adequate redressal mechanisms, transparency, and accountability? Who can ensure that consumers are not locked in and that they can easily switch to other providers when they find better offers? Answering these questions is becoming increasingly difficult, and it is important that we do not lose sight of these risks. My third and final point is about regulation. Policymakers and regulators will have to carefully balance enabling regulations with safeguards against the downside risks. Right now, to be very honest, we are still lacking the evidence to know the extent to which embedded finance exacerbates existing risks or is creating new risks. We need far more demand-side research and policy research, and we need to identify the emerging good practices. However, we do have some foundational principles that can guide us in these early stages. First, we know that we have to better define the contours of the regulatory perimeter. The emergence of hybrid business models makes it difficult to understand what falls under financial regulation and what doesn't. This causes uncertainty and may deter innovations in the long run. Second, we need to ensure a level playing field. Non-financial companies may provide financial services without being subject to the requirements and supervision standards that are applied to regulated entities. And as business models continue to evolve, the principle of same activity, same regulation may be undermined, leading to questions of consistency and credibility of regulation. Third, we need to promote interoperability and open architecture within the financial system. Financial sector initiatives should be pursued to enhance open markets and access to data. For example, through reforms of the central financial infrastructure, payment systems, credit bureaus, digital identity, and by encouraging open banking frameworks. Many digital firms nowadays wield significant market power across a broad range of services. If they have and abuse a dominant market position, this could harm not just consumers, but also financial institutions. Competition authorities and regulators may be concerned about the detrimental effects on market stability and competition. Fourth, we need to clarify the role of agents, third-party vendors, intermediaries, and outsourcing protocols. The meaning of all these terms is changing in embedded finance. Tech platforms are often operating as agents of the banks of some sorts, but their role is obviously significantly different from the traditional bank agents that we have seen and that have been regulated for many years. The role that they play in the design, marketing, distribution of financial products needs to be more clearly defined and governed. Furthermore, much of the regulatory guidance on the due diligence for banks' third-party vendors comes from an era when these vendors were service providers to the banks. But in embedded finance, it often works the other way around. Banks are embedding their offerings to tech platforms. So it is them who provide a service. And in fact, the term banking as a service is growing and is closely interrelated to embedded finance. Just to conclude, the value chain of finance has changed and is changing a lot. And it is becoming obvious that the older regulatory structures often just don't work. We are at the early stages of understanding the potential and risks of embedded finance. And I think that we need to join forces at this stage to develop more evidence, thought leadership, and identify the good practices and the bad practices to guide regulators, investors, and consumers on how we can make embedded finance truly inclusive and developmental. At the Center for Financial Inclusion, we're prioritizing this theme, and we're working together with various partners and building the evidence needed to inform better policymaking regulation. And I hope we can continue working together, and together we can lay the foundation for a more inclusive and responsible growth of the sector. I want to thank you all for giving me the opportunity to speak today. It's been a pleasure, and I hope you enjoy the rest of Financial Inclusion Week. Thank you.